Hello, welcome back to Let's Talk Tax, powered by McGuire Sponsel. I'm your host, Jerry Hammel, and today we're talking about international tax compliance, what business leaders really need to know. I'm joined by my colleague, Catherine Yuan, a manager in our global business services team, who helps companies navigate these cross-border challenges every day. Catherine, thanks for joining me. Let's get started.
Thanks, Jerry. Excited to be here and talk about how businesses can stay compliant and strategic as they grow globally.
Yeah, and I think so. Today, just as a little preview, we're not going to get into the technical nitty-gritty today. Today's just more of a high level of things that maybe to watch out for, as you're operating globally, and some of the compliance that goes with that. Not only the legal obligations, the reporting and all that, but just how you manage that risk. So. Well, a lot of this should be fresh in your mind because we just finished the October 15th extended due date. And I see you survived that.
Yes, definitely.
Yeah,
It's a difficult season, but we definitely got through it. There are some experiences I can share in this episode, so businesses can be aware for the next filing season.
sure. And so I guess maybe talking about just the returns themselves. So how do you help CPA firms, like in what capacity, in that international reporting?
Yeah, definitely. We help CPA firms however and whenever they would like. For example, we can help CPA firms who don't have the capacity to prepare and review returns. We can log directly into the CPA firm's system, prepare the return directly in their system, so those can be e-filed with the federal tax return. Or if the CPA firms would like a second pair of eyes to review, they can send the returns to us. We will send back comments for them to update the returns, and then they can have their staff review and update accordingly.
Okay. Yeah, it makes sense. And it seems like we have a lot of options to fit maybe what resources they have internally and really try to complement that.
Of course.
Okay. Um, Maybe just if there is such a thing as a typical process, because they're probably all different, but let's pretend there's a typical process. How does it really go from start to finish once it's been identified and we're going to help a CPA firm? Let's just say it's going to be turnkey. So we're going to prepare and review. What's that process look like and how does that work?
So the first step is always identify the scope. We will prepare a filing obligation roadmap, listing out all the entities and all applicable forms. Then we will send the roadmap for the CPA to review so we can all agree all the filing obligations will be satisfied. Our staff will then prepare an information request to be sent to the client. The client will upload their data, usually the financial statements, intercompany transaction reports, or simply the trial balances, to our secured share file site. We will then use the data to prepare work papers and returns in the system. And when it's all prepared and reviewed, we will upload a PDF copy of each return for the CPA firm to review and to keep in their files.
Okay. Boy, it sounds like there's a lot of steps involved in that process. So I assume when you're talking about this roadmap that part of that initial conversation is looking at the ownership structure, right, to help build
Yes.
that roadmap out.
Yes, of course. One of the most important thing we always ask before we start any obligation is an org chart, preferably a very detailed one. However, if the client or the CPA firm does not have an org chart, we can, of course, draft one based on the client's description and situation. And then we will analyze the ownership structure to make sure all the entities are captured.
Okay. Yeah, and certainly getting everyone on the same page up front with that is probably the critical step before you start going down the road of beginning to gather information.
Of course.
Yeah. Well, so thinking back to that, so there's that typical process or structure. What in that within that structure or that process, um, what are some of the things that you experienced going through this latest deadline? Maybe where things get held up or you hit potential roadblocks and that we have to work around. What are some of the challenges you run into?
So I would say the first major point is the global operating footprint. Like I said, our chart is always helpful. However, I understand that every country has its own rules. For example, what triggers registration, when a company is considered to have a permanent establishment, a PE is what we call it in a certain country, what needs to be filed locally, when tax returns need to be filed locally. I bring those up because foreign tax credit and some EMP adjustment need to be relied upon the local tax return. Businesses often underestimate how easy it is to create a taxable presence just by sending employees abroad or signing contracts. It is not uncommon for us to see clients coming to us near the deadline, bringing up permanent establishment or taxable presence in foreign countries that triggers US tax return obligations. So the first key is to map where activities occur and understanding thresholds before expanding. It is difficult to resolve those taxable presence and costly to have US filing obligations by having a permanent establishment in foreign countries.
Okay.
And then the second problem is always the data and the reporting challenges. But the most stressful situations we saw in the past filing season came down to data and timing. Even companies that are very sophisticated can run into issues when local information isn't complete or aligned across jurisdictions. For example, we had several clients who realized right before October 15th deadline that new foreign entities have been formed. However, no local tax reporting or financial statements have been prepared.
Hmm.
Because those weren't communicated early enough, we had to scramble to prepare the forms at last minute to meet the deadline. That kind of late discovery is risky because it compresses review time and increases the chance of errors.
Sure.
Another common issue is always delaying receiving financial statements from foreign jurisdictions or for receiving financial statements that are not in English or US compatible formats. Many local accountants close their books not in accordance with US rules or US deadlines. Um, and we spent a good part of September chasing down trial balances, converting foreign languages into English, or just simply making sure balance sheet balances so we can tie everything together.
Yeah, so not only accounting challenges, but also different languages, getting that converted, getting in a format that the IRS would like to see in some of these international reporting forms.
Absolutely.
Yeah,
This is why we always encourage companies to make early discovery, plan ahead, and centralize global reporting, whether through a shared platform, ERP integration, or just through a coordinated calendar with their local teams can be very helpful. When you consolidate early, you reduce the manual work and last minute surprises.
okay, sounds good. So let me ask you this. So how often do you get involved early on, when someone knows that they're going into a different jurisdiction or anything? I mean, it seems like it'd be ideal for the CPA to involve us in conversations then to cover some of that.
Of course, I would say in an ideal world, people would consult their tax advisors before making every single business decision. However, we understand that tax, especially US tax, may not be the key driver of every single business move or decision that needs to be made.
Sure.
But still, it is very, very preferred to consult your US tax advisor before you decide to expand globally. And we understand that global expansion is happening faster than ever right now. Companies continue to hire remote teams, setting up entities abroad, or selling into new markets almost overnight. That brings new reporting obligation in each jurisdiction. And also, the IRS are asking for more data and increasing scrutiny. A small misstep in one country can quickly escalate into penalties and even reputational issues across the group. So it is not only advisable, but also it is a strategic safeguard to consult your tax advisors before making global expansion decisions.
Yeah. So now I know, maybe to clarify for everyone, what you're doing and your team is doing is you're doing the international reporting that goes into U.S. tax returns, correct?
Yes, that's correct. Often people can misunderstand the term international compliance as foreign compliance, which is for companies who have foreign, aka non-US entities, to file their local tax return, local registration, local tax obligations. That is not what our team is engaged to do. We're US CPAs. We cannot advise on foreign tax
Hmm.
obligations or positions. However, we're qualified and often engaged to advise on US positions for foreign expansion decisions that are impacting US parent companies or US subsidiaries for foreign companies.
Yeah. So in those cases where maybe you've got a client and they're operating in two or three jurisdictions and they need some local help in that foreign country or that foreign jurisdiction, what do we can we make recommendations?
We certainly we cannot make definitive tax answers. However, we have a global alliance network that we can refer the client to, and the client can make contact with the local team on their local tax positions.
Okay, so while we're not qualified to do that work specifically, we can get them connected with somebody local and to
Yes,
help them
of
out with those
course.
local filings. Yeah. Okay. Um, maybe not to get too specific, like form pages or lines and that, but what are some of the common things that you see from a risk standpoint on the actual forms themselves? Let's just take like a 5471 where a U.S. company owns a foreign subsidiary.
I would say I am glad you brought up 50 or 71 because that's one of the longest forms there is to be prepared. Um, 50 or 71 are applicable to CFCs, which is controlled foreign corporations. That brings up our guilty or after OB3 is going to be called necktie, NCTI regime, and subpart F regime. Those are anti-deferral regime that basically tax foreign earnings as if those are repatriated immediately back to the US. People can be unaware of foreign earnings taxability in the US and therefore underestimate their US tax liability.
Hmm.
In addition, people can invest in foreign investments, for example, insurance companies, without realizing that even a very small percentage in a foreign investment can have PFEC implications. Those are very punitive charges, and a first year election needs to be made to avoid those punitive charges from a tax standpoint.
Okay. Okay. And it sounds like some of this is fairly critical. Like it sounds to me like if you don't get some of these calculations done and you're not tracking previously taxed income, for example, then down the road, subsequent down the road, if they sell the company or they take a distribution, you may not have the right information to determine the taxability. Is that right?
Of course, yes, definitely. When I'm glad you brought up the previously taxed income, what we call as PTAP. Without tracking PTAP, you will not be able to calculate the Section 96C gain or loss. I know code sections are often overwhelming, but basically it's a gain or loss calculated for the time you actually got taxed on the income and when you actually got repatriated cash of the income. In
Okay.
addition, you have to calculate EMP, which when you sell a company, to the extent of EMP, the gain will be recharacterized into dividends and subject to ordinary income rate instead of capital gain or loss rate. So it is very incredibly challenging when you don't have a good record of all the past earnings from a foreign corporation you have interest in.
Okay. Interesting. And I think so. What do I'm coming back to something you said earlier, where it's very challenging. You get right up to the due date. Let's say you get it. It's obviously better to file than not file, correct?
Of course.
So
Of
what do you
course.
do if you're having trouble getting that financial information or certain pieces of it? How do you usually handle that when you're that close to the deadline?
First of all, I would say always plan early, plan ahead, give us plenty of time. However, if we don't have enough time, we will have to make reasonable assumptions. We will file based on the best available information we have. Often the client may still have difficulty getting information themselves. So we will just have to get the best available data from the client, file under the reasonable assumption, and when we file the returns, we will attach a statement stating these returns are filed based on the best available information and reasonable assumption. Then immediately after filing, we will have to start plan for remediation, which is filing amended 2024 return for the past year um, with hopefully the complete data set from the client. It really needs to have all the information, all the financial statements, all the intercompany transaction data, and we will build a timeline. After discussing with the client what challenges and missing information we had in the past filing season.
Okay. So even if you don't have all the information, there's still a plan. We can still get them filed, but the work's not done yet.
Exactly. Always
Yep.
plan ahead, even after the deadline.
Okay. Well, that's great. Really appreciate you joining me today, Catherine. I think the message I heard loud and clear was that early planning is best, regular communication, and some of the early planning I think is, as companies are going into foreign jurisdictions, plan for the accounting and the reporting, and if they know these reporting requirements ahead of time, they can design their systems and processes so that the information is more readily available.
Yes, definitely. I completely agree. I just want to emphasize that US international compliance is a strategic imperative. It shouldn't be considered as a cost center. It's part of the foundation for your global business.
Sure, and I know I think that's an excellent message because you need to be strategic about it. They are from the business side, but there's a lot of other costs to operate in foreign countries or jurisdictions. And so if you try to take the cheap route early, it's probably going to cost you more in the end in terms of penalties or some other types of failure to file costs.
Yes, definitely.
Okay. Well, very good. This has been really fun and really interesting. So I appreciate that. And congrats on getting through another extension due date. And again, thank you, Catherine, for joining us today.
Yes, thank you, Jerry.
If you'd like to learn more, connect with our global business services team. We're always glad to continue the conversation and certainly take this into more depth with your specific client situation. So thanks for listening to Let's Talk Tax. And don't forget to subscribe so you don't miss future episodes.